What's up, everybody? Thank you for tuning in to another episode of the CPA Zone, the podcast where we discuss tax strategies and accounting tips for entrepreneurs and real estate investors. My name is Ryan Pulis, and our company, the Pulis Group, offers tax planning and advisory services for entrepreneurs like you. Whether it's bookkeeping, tax planning, or CFO services that you're looking for, we've got you covered. What's up, everybody? Welcome to another episode of the CPA Zone. Today, we're going to discuss a tax court case that involves a failed 1031 exchange. So this is the Blangiardo v. Commissioner case. Hopefully, I'm pronouncing that name right. It's Tax Court Memo 2014-110. So this tax court case touches on two important topics for real estate investing. So first, we have the right way to do a 1031 exchange. And then two, it talks about the correct way to calculate basis. There's sort of a not necessarily unique piece in here that impacts basis, but something that's just is not as common and could trip up a lot of people. So wanted to touch on both those items. So a little background. The taxpayer in this case, Frank Blangiardo, purchased a property, we're going to call it Property A, for $488,000 back in 1995. Over the years, he went through two divorces and paid settlements to both ex-wives in exchange for him keeping the house. So the first wife got $500,000, and then the second got $80,000. Apparently, the first wife kind of worked out a better deal here. She must have had a much better lawyer getting that much more money than the second. But fast forward to 2008, that's the period under exam in this particular case. He sold Property A through doing a 1031 exchange, sold Property A for $2.25 million. Within 2 weeks, purchased another property, Property B, for $1.4 million. And he's claiming this is a valid 1031 exchange. And he used his son, an attorney, as his qualified intermediary and held the sales proceeds in a trust account. It sounds okay, maybe, but it's not. Unfortunately, it's a good way to ruin a 1031 exchange, which we're going to see is exactly what happens in this case. So here's where our taxpayer messed up. He used his son as a qualified intermediary. Under the 1031 exchange rules, your intermediary cannot be a related party, includes your kids. A qualified intermediary serves many important roles for a 1031 exchange. They're going to be the one that holds the sales proceeds and prevents the taxpayer from taking possession of those funds, which is key for the 1031 exchange. They're also going to help make sure you don't cause or make any mistakes that can cause you to lose the tax deferred status. They're going to kind of work with you throughout the entire exchange period and help in that regard. So a good qualified intermediary is really key to successfully completing a 1031 exchange. But there's rules on who can serve that role, and the rules are pretty strict. Your intermediary needs to be an independent third party. So using your son, like Frank did, even though he's a lawyer and he set up a separate trust account, it's not allowed. His son's considered a disqualified person for purposes as serving as a qualified intermediary. Your qualified intermediary cannot be a relative, cannot be one of your agents. So your accountant, your real estate agent, your attorney, your investment broker, they're all prohibited from serving as your qualified intermediary, and even your employees are as well. So despite the timing being good in this one, he used his son as a qualified intermediary and it blew up the 1031 exchange. And as a result, he recognized a gain of about $1.5 million, $1.5 million, a little bit over. So let's just quickly review the IRS rules for a valid 1031 exchange. So first, you have to have like-kind property. So in this case, like-kind property is real estate for real estate. It has to be business or investment use real estate, not a personal residence. Another issue in this case was the taxpayer, the Property A that he's giving up appears to be a personal residence. This was in the footnotes. It really wasn't one of the key points in here, but reading the footnotes, it becomes clear that this was a personal residence. It wasn't an investment property or a business property. It was a personal residence that he kept throughout the two divorces. So that's another deal breaker for 1031 exchanges because a personal residence does not qualify. has to be business or investment property. Then we have the timing rules: identify replacement property within 45 days of selling the relinquished property, and then close on a new property in 180 days. Everything in this quick case appears that he got this part right, but he missed the like kind piece. And as we already touched on, the qualified intermediary has to be an independent third party, not your relative or an agent. And he used his son, so that ruined the deal as well. The title and use, the new property has to be used for business or investment use as well. And then the same taxpayer has to be on title for both the relinquished property and the replacement property. So it's the same taxpayer on both sides of the deal. So missing any of these key points can blow up the exchange, just like what happened to our taxpayer, Frank. Now, the next piece are in calculating the gain. 1031 exchange disallowed. He has a taxable gain. He tried to include in his basis the amounts he paid to his former spouses. So the $500,000 to ex-spouse 1 and $80,000 to ex-spouse 2. So he added the $580,000 to his original purchase price of $488,000, which actually it seems reasonable. I mean, you paid this money to keep the residence. However, under Section 1041, property transfers between spouses that are incident to divorce are treated as non-taxable gifts. And whenever a gift is involved, the recipient of the gift takes the donor's basis in that property. It's not the value of what you paid. So for Frank, our taxpayer, his basis stayed at that original cost, the $488,000. He was not able to add the money he paid to his ex-spouses to that basis. That means his capital gain was way higher than he expected. So again, just to review, how do we calculate our adjusted basis in a property? Well, first you start with the purchase price. That's your contract price plus closing costs, any title fees and legal costs related to the acquisition. Add in any capital improvements, like a new roof, or maybe put in an HVAC, any of those major renovations, just not your typical repairs and maintenance. And then you subtract out any allowable depreciation. So if the property was rented or used in a business, it's going to be depreciated. So your adjusted basis is original cost plus improvements minus depreciation. Always be sure to document everything and be able to back up this calculation with adequate records, especially for the improvements and depreciation. However, no, you cannot add to your basis, as in this case, any amounts that were paid or received due to divorce, because those are considered gifts. So final takeaways are: use a legit qualified intermediary for any 1031 exchange. No friends, no families. Go find a professional that specializes in this. They are worth their weight in gold. Don't assume divorce payments increase your property basis. Even though it seems like in this case that he did pay the money, he should be allowed. There are rules under Section 1041 that say that if these are technically gifts, they're not going to increase his basis. And make sure you get professional help when handling complex transactions. If he had hired this out, which it doesn't sound like he did, he may have found a competent person to help and would have got the transaction handled correctly for him. So that about does it for today. I hope you found value in this episode. If so, please leave us a 5-star review and hit that like and subscribe button. Until next time, have a great day. One last thing before you go. We have put out a free ebook for our listeners. You can find a link to this in our show notes. It's called the Rental Real Estate Investor Tax Guide and covers all the basic tax-related information for real estate investors. We hope you like it. Again, go to the show notes to download your free copy. So that about does it for this episode of the CPA Zone. Thanks for listening, and I hope you found something valuable that you can take away. We are taking on new clients, and if you'd like to work with us, then go to our website and fill out the client intake form on our contact page. This can be found at thepulisgroup.com/contact. That's ThePulicegroup.com/contact.